Recording? All right. So we continue with our chapter 1. This is our second lecture. We had two students coming and asking the following question, okay? And the question was, can you explain again what the select economic events is, okay? So, example is, you have a little restaurant and it's raining outside. Do you record the rain? No, you don't record the rain, okay? So, you choose not to record the rain. Then, you have a restaurant. You buy a table for customers. You pay $500 for the table. Do you record the table? The answer is yes, it is important for business, okay? Then, in your restaurant, you use, let's say, fish. You go on the fish market and spend $5,000 on fish. You use the fish to cook, okay? I mean, to prepare meals. Do you record expense of $5,000 for fish? Yes. So, if it affects your business in somehow directly, you spend money on it or get money from it, then you record it. So you select things which affect your business. Customer coming to the store, looking at the menu, don't like the prices, okay? Price no good. Then he returns the menu and continues, okay? No real customer, okay? We call this in business and in marketing prospective customer. So, do you record customer coming in and going out? No. There is no money. You don't give him money, you don't get money from him. There is no revenue, there is no expense. He's just a guy walking by who likes your waitress, okay? No real business, okay? So, you need to select economic events which relate to the business of making money, okay? So, rain coming in doesn't matter, okay? Customer come in and then go, oh, they're not a real customer. Remember, customer is someone who paying money. So, if the customer pays the money, he says, oh, I like to order whatever fish with this and that. He's actually paying, then you record, okay? Next, you pay for insurance. If you pay for insurance for your store, then it is a transaction. It is an expense. You pay for insurance. So, you say, oh, I will choose, select this. So, a payment for insurance, you must record, okay? Then, you have a waitress. You have to pay the waitress $10,000, okay? You must select, okay? So, you choose to record, okay? Then, you pay rent. You choose to select, okay? Then, you pay electricity. You also choose. So, this is about choosing to record or not to record, okay? And if it's affecting your business in some sense of with money, you must record, okay? For example, you pay for advertising. If you pay for advertising, you must record, okay? But if you put in a little sign and you say fish sold here or fish restaurant, okay? And the sign doesn't cost you anything, then you don't select, don't record. So, this is about choosing whether to record it or not to record. And you choose if it's affecting your business? Oh, we also need to put the power in. We forgot the power, right? Okay, so power on. Okay, so you choose to select to record or not to record. Just because there is some rain, no big deal, okay? Taxi, drive by, no big deal. Customer coming to the reception and asking, how much is the price for the hotel? And they say, 2,000. I says, too much, don't want to pay, okay? Or 5 customers say, we want to take a room, and you say, there is no room. Well, if there is no room, you do not record. No revenue, no expense. But if you say, okay, pay 2,000, and they say, okay, pay cash 2,000, then you record, okay? So, if it is affecting your business with money going out or coming in, okay? So, if there is any specific benefit to your business, customer walking in and then going out, no real benefit, okay? Real benefit is when there is cash, when there is payment, okay? So, that's the explanation of identification, okay? You select to record or not to record. Remember, accounting is about recording. In here, you select record yes or record no. Okay, back to 16 is where we were, right? Aha. So, in accounting, we have assumption. Assumption is something which you take for given. You take for granted. You take it as it is and you don't worry too much about it. And there are 2 fundamental assumptions in accounting. 2 assumptions. The first assumption and the second one. The first assumption is the monetary unit assumption. In monetary unit assumption, is you include only transaction data. This is actually answering your question, what to include and what not to include, okay? And you include only transactions that can be expressed in terms of money. Okay, that's the key. Is it relate to money or don't relate to money? Customer coming in, looking and then going out, well, no real money here, okay? Rain falling, well, no real money. Taxi driving by, no real money, okay? But if the customer sits and says, I want to order fish with whatever and all the other things going to cost 300 with a beer, right? And then they pay 300 or 320. Then there is real money. So here the assumption is that it must be able to be expressed in money. And there is some real value. You either pay value, well, you pay your electricity, okay? You pay your rent. You pay the waitress, okay? So you pay some value, usually in the form of money, or you as a business receive value. But you express it in terms of money, okay? So, for example, you have a customer in your hotel. Customer from Britain paying every night 2,000, 2,000, 2,000. So the customer stays for 10 nights, he pays 20,000, okay? So he pays 20,000 cash, you take the money, you record it, okay? And then he says, I'm very happy with your hotel. Your hotel, very good. Next year, I come with my friends for 2 weeks. Do you record anything? No. There is no money. There is a promise only, okay? Again, is it a real contract? Did he give you a deposit? No, it just says, oh, your hotel very nice. Oh, I'm coming back next year, okay? That's no good. When next year, when he comes with his friends, okay, then you report the real revenue. So, he says, oh, I'm coming next year. Well, there is no real money here, okay? It's just a guy talking, okay? If you say you sign a contract, next year he's coming for 10 days, you sign a contract, he gives you a deposit. If then he does not come next year, he loses the deposit, okay? So he makes a reservation. That's a real economic, there is real money. If there's a contract, there is money, okay? So, similarly, let's try something else. Here's another one which is coming on your first quiz. You open a little restaurant and you hire today a waitress, okay? You hire today a waitress and says, today, June 6th, okay? 6th of June. And says, when it comes June 30, meaning at the end of the month, I pay you 5,000, okay? Do you record today anything about the waitress? Yes or no? Well, what do you record? What do you record about the waitress? Okay? So June 6th, you open the restaurant. You say, you're going to be my waitress? Yes. I'm going to pay you at the end of the month 5,000. Do you record anything? The answer is no. Today, you do not record anything. At the end of the month, when you actually take 5,000, say 5,000 salary, then you record, okay? And it is part of this, well, not just monetary unit, it's actually the principle you actually made a real expense then, okay? We will study this in the next 12 weeks. But it's important for you to understand, because just say, oh, I'm going to pay you at the end of the month, does not mean you record it now. Sometimes you record now, sometimes you record later. I will be explaining this, okay, in coming weeks, okay? But you have to be careful. And the second fundamental assumption, the first one is monetary unit. The second one is economic entity. And I already explained economic entity. Economic entity is the same as business, okay? So, one restaurant, economic entity. Hotel, economic entity. Entity is the same as unit. One piece, one business considered together. Yeah, you sometimes have to open those little dictionaries and write entity, right? Okay, that's what you do, right? So, entity requires that the activities of the entity, meaning the business, right, of the entity, is kept separate from the activities of its owners. Okay, let's explain this. Before, I worked in the Middle East, okay? And in the Middle East, you got one owner owning the business, okay, his own restaurant. He, the owner, mixing his personal money and personal finance with his restaurant. For example, he's using his restaurant to pay his electricity at home. Okay? Well, cannot do that. That's not good. That's not right. This causes problems, okay? He can still take the money later, pay him dividend, and then do with the dividend anything he wants. But he cannot just use, oh, pay electric for this. Oh, then buy my wife iPhone, right? That would be good, right? So, you cannot use business money for personal stuff and record it in the business. So, in the business, you record things which are only related to the business. And that's the economic. It requires, okay, you must record activities only of the business and separate from the owner, okay? That's very important. So, what really happens is they get to mix. They have, let's say, 3 businesses. 1 restaurant, 2nd restaurant, 3rd restaurant, and then he's using money from 1 restaurant to pay for the other restaurant. This happened here a lot, right? And then, or they have 3 massage parlor, right? He's using money from 1 to pay the rent for the other. He's using money from the 2nd to pay the electricity from the 3rd, or to pay some people, and then he gets, all of this makes things really complicated. It really makes confusing. So, you got 1 business, you keep the business separate, okay? You got your own person, you keep it separate. Well, you say, but he's an owner, okay? An owner wants to take money from the business to pay for his food, for his phone, for his electricity, okay? The solution is simple. You do your business only, and at the end you say dividend, meaning business paying cash to the owner 50,000. So you take dividend 50,000, okay? You transfer the money out of the business 50,000, okay? Or out of the cash register 50,000. You record it as dividend, then you take the money in your pocket and you can spend it any way you want, okay? So every time the owner takes money out of the business, you simply record pay out dividend, okay? And that's the solution. I'm not saying that the owner does not take money out of the business. I'm saying every time the owner takes money out of the business, you just say pay out dividend to the owner, okay? And you just record it, okay? Then he takes the money out and spends it any way he likes, right? Usually just give it to his wife, right? Okay, so the next piece, I don't know how important and relevant is in Thailand here. You got 3 major forms of business. All right? If you cannot see, you just move up here, okay? And the 3 major forms of business are proprietorship, partnership, corporation. Proprietorship means only one owner. One person owns the business, okay? So proprietorship is the same as single owner. Single owner. Proprietorship means single owner. One owner. Very, very, very common. Sometimes it's partnership. Partnership will be 2 people together own jointly. It could be 3 people, 4 people, okay? Sometimes, or very commonly, it is husband and wife. Husband and wife, they have a partnership. Well, why would they do partnership? Well, the business is owned by both. After 3 or 10 years, if they separate, the business splits 50-50. Or if they agree 60-40, okay? So, sometimes you may want to have, here in Thailand, especially in Thailand, it is very common to have a partnership when a Western man, right, a foreigner, marries a Thai person, okay, and they jointly open a business, or even without marriage. If I want to open a business, I need to have a Thai Co-owner, we call it a partner. To own 50% of the business, we say 50% plus 1, right? To be, we call it majority owner, okay? This is required by law. Here, the law says foreigners cannot own business. They can own only minority. Minority means less than 50%. Thai person must, or Thai people must own majority, okay? So, for example, I own 40% and you own 10, 10, 10, 10, 10, 10. So, 6 people owning 60% and me, I own 40. Is this okay by law? Yes. The law says not Thai person, meaning Thai citizens owning a majority. Well, we call this partnership, okay? Joint ownership. And finally, the last type is called a corporation. Corporation is a separate legal entity. It is separate from the people. And I don't know exactly corporate law. You have here corporations? You probably do. I don't know exactly, haven't studied. But all Western countries have corporations, okay? You actually are very, very, very familiar with corporations. All the brand names that you use are usually corporations, right? We're just talking in the break. Samsung is a corporation from Korea. Maybe you like Sony is a corporation from Japan. Honda is a Japanese corporation. Toyota, the Japanese corporation. Apple, right? You all use Apple here, right? Is an American corporation. So usually, don't think corporation is a brand name. Corporation is a company. And the company will have different brands. Well, for Samsung, they will say Samsung Galaxy. Okay? Galaxy is the brand name. Okay? Apple will be iPad. The iPad is the product brand. Okay? So you have a company name, a company corporation, okay? And then you have a product brand name. Common, the most popular here or around in China is iPhone, okay? iPhone, the most popular. Now you go in Macau, well, I just come from Macau, is Galaxy, okay? Year and a half ago, everybody had an iPhone. 1 year later, meaning 5 months ago, everybody having Galaxy Note 2, right? Very important. Okay, so this is what the corporation is. And of course, you know, Toshiba, and oh, you guys are using here HP, Lenovo. Okay, these are all corporations, okay? Corporation is used for very, very, very big business, okay? With usually thousands of employees and sometimes thousands of owners. Okay, and they again explain proprietorship, partnership, corporation. We have there, hello, maybe you two will have to separate, huh? Because you just keep talking, okay? It's still class, it's still, I know, it's about accounting, right? 10 more minutes, okay? And then you can talk all you want. All right, so, again, repeating the stuff. Owned by one person. Repeat, okay? Very small type, small business. Usually, service, little hotel, little restaurant, okay? Little massage, okay? Next, only receives any profits. We call these dividends, okay, and suffers any losses. So, whatever the profit, he takes. Whatever the loss, he takes. Okay, that's fairly straightforward. Now, partnership, I explained. 2 or more people. 2 or more. Usually, again, retail and service. Retail means selling goods to customers, okay? Maybe selling iPhone things, or maybe whatever, selling watches, or maybe selling shoes, or maybe selling shirts, okay? And unlimited personal liability. If there is a problem, he pays out of his pocket, okay? If there is a problem, he's got to pay. If, he cannot cover with the business profit the loan to the bank, he will have to take it out of his own money, okay? So, he or the owners take a lot of risk. Same here. And usually partners, 2, 3, 4, will have a partnership agreement. And for the corporation, I was already explaining earlier on in the previous video that owners are called investors, okay? These investors own shares. So if you own a share, an investor owns a share, it's called shareholder because he holds the shares. So you have shareholder. Another name is stock, and they call it stockholder. Okay, stockholder. So you call them shareholders, you call them stockholders, you call them investors, okay? They, meaning the corporation is separate legal entity from the investors. So the corporation separate from the investors. And investors have limited liability. Now, liability in this particular case means responsibility to pay back debts and other obligations, like bills for electricity, bills for mobile, bills for other services. So, if there is a problem with the corporation, the investor is not responsible. Okay? For a proprietorship, he is responsible to pay the electricity, to pay the mobile, to pay internet, to pay. Here, the partners are responsible. In a corporation, they're not responsible. Review question, you will read on your own. Review question. And we begin a little bit today with the most important. They call it the fundamental accounting equation, or they use here basic accounting equation. You will need this, you will use it all the time. Equation means it's got an equal sign, okay? And in this particular case, it is always true. So always true. So every time you solve a problem, you will have assets equal liabilities and owner's equity, which is what I will be explaining in the next 10 minutes. We have how many more? About 10 minutes? 15? Yeah? Okay. So, first of all, it says provides the underlying framework. In other words, this is the foundation of accounting. The foundation of accounting is this simple equation, which we will be using for the rest of this course. And accountants use all the time, always, for everything. Okay? So, I'll be explaining what are assets and everything else. Assets coming here are claimed by creditors or owners. Let's try to explain this. This is a little tricky because they didn't say exactly what is asset. So, asset. Let's see it coming up here. Yeah. Assets is a resource which the business owns. To own means that you actually have it and you control it. So the key to an asset is ownership and control. Asset is something of value. Asset is easy to understand. Table, chair, monitor, watch, shirt, belt, whiteboard, projector, okay, classroom. One of the major assets, which everybody understands, is real estate. Real estate is divided into land, okay, land is a major asset. The other major asset is buildings, okay? So somebody owning a garage, well, the garage is an asset. Somebody owning a land is an asset. Well, what about a tree? You own a tree, a banana tree, is it an asset or no asset? It depends. If you own it, if you control it, and here's the key, it brings value. Is the tree making money or not making money? The answer is, if it is making money, it is an asset. That's it. If it is making money, it's an asset. So, if you own a banana tree, and the tree is actually productive, it's actually producing fruit, you actually take the fruit and sell it, it is an asset, okay? You own a car. Is it an asset or not an asset? A car. Well, again, it is asset for your family, but the question is, do you use the car to make money? So, if you use the car as taxi, it is an asset. It becomes a business asset, okay? All right, so, well, I own this nice little galaxy. Well, it's not little. So, is it an asset or not an asset? Okay, so I'm going to give you the next key. We divide assets into business asset and personal asset. And here's the key. This is a personal asset. I don't use it to make money. I don't use it for business, okay? I use it for personal stuff. So, if it's something of value, if it's used by the business to make money, you call it business asset, okay? You record it in the business. Otherwise, it's a personal asset. Personal asset, you don't record in the business, okay? You just don't. Now, it may happen that you have a little scooter. You use it for your own purposes, but sometimes you also use it as a taxi, okay? Then it's a little tricky. If you use it 50-50, half time for you, half time for the business, then you have to say, scooter is 40,000, you record half of it in the business, okay? So, it's a little tricky, but an asset, number one is the business owns the asset, okay? So, you usually record it when it's part of the business, not your personal watch, okay? Well, let's try this. Camera, you see this camera, Sony camera here, which will record. Is it an asset or it's not an asset? Yes, it is. Is it business or personal?
No.
Whose business? Well, the answer is, first of all, it is an asset. Second, it is my personal asset because I pay for it, I own it, and I don't use it to make money. I don't use it for or as a business. Now, if I have a separate business, okay, and on the internet I'm selling videos for download, okay, and I make $1 per video, okay, then this becomes a business camera because it would be used, but I don't. And if I don't use it for business, I don't make a revenue out of it, it is not really a business, just a personal asset. Okay. Here's the key. It provides future services or benefits. Well, what about a chair? Chair provide future service or benefit? Yes. Table provides future benefit. I mean, table is going to be here tomorrow. Same thing, mobile will provide future. Camera will provide. The projector, the whiteboard. So an asset is something that you can use today and usually in the near future. Okay? So the key is it will, we say, will bring value. And the final piece is, okay, assets include cash. Of course, cash is an asset. Why? It can bring value anytime. You can use cash to buy anything you want. You buy electricity, you buy water, you buy tea, you buy watch, you buy fish, table, whatever you want to buy. Supplies. You know what supply? Supply will be pen, paper, paper for the printer, okay, all of those things that we use here. The university uses a lot of supplies, okay, all the paper stuff that we use. And finally, equipment. Equipment, of course, is an asset. I just show you a whole bunch. The camera, the monitor, there's a computer. Another equipment here is the power, electricity here. The projector is an equipment. This little thing here, okay, is also an equipment. It's cheap, but it's still an equipment. The whiteboard over here, it's actually glass, right, is also an equipment, okay? And this table, we don't call it equipment, we call it more like furniture, okay? So, table, oh yeah, well, how about this? Keyboard, equipment, okay? Printer is an equipment. So, all of these that you see here are assets of the university, except for the camera, which is my personal asset, okay? Well, what about the iPad? Who owns the iPad?
Personal.
Oh, it's your personal asset, okay? Do you use it to make money? No, okay, so it's a personal asset. But if someone's running some website, okay, let's see what else we have over here. Okay, let's finish liabilities in a few minutes, or maybe we continue next time, huh? Is it better to do that? All right, liability is too important. We continue next time with liabilities, and hopefully next time we finish the chapter. Okay? All right, thank you.